Okay, let's talk about options trading. I know. The term itself can sound super complicated, right? But what if I told you the main idea is actually something you probably already get? That's what we're going to do today. We're going to demystify this, piece by piece.
I mean, think about it for a second. You insure your car, you insure your house. It's just a normal way we manage risk, right? So what if you could do the exact same thing for your stock portfolio? This is the perfect way to start thinking about one of the most powerful reasons people use options.
All right, so let's get right to it. What is an option, really? Well, at its core, it's basically a contract that gives whoever owns it a really powerful choice.
To really make this click, let's just forget about the stock market completely for a minute. Let's talk about something more familiar. Imagine you're thinking about buying a house in a brand new neighborhood that's still being built. Okay, so here's the deal. You find this house you love, and you pay the developer a small, non-refundable deposit. And what that does is it locks in the price. Let's say it's $400,000 for the next 3 years. Now, this is the most important part. You now have the right to buy that house at that price, but, and this is key, you are not obligated to. So if the housing market goes crazy and that house is suddenly worth double, you can exercise your right and you've got yourself an amazing deal. But if the market tanks, you can just walk away. The only thing you lose is that small deposit. See? You've just walked through the exact logic of how an option works. In that homebuyer story, that leads us perfectly into the official textbook definition. An option is just a contract that gives the owner the right, but not the obligation, to either buy or sell something, an asset, at a fixed price, which we call the strike price, for a set period of time. It's the same exact principle we just talked about with the house. Now, you might also hear people throw around the word derivatives when they talk about options. Don't let that fancy term scare you off. All it means is that its value is derived from something else, an underlying asset. So for a stock option, its value is tied directly to the price of that stock. Simple as that.
Okay, so we've got the what. We know what an option is. Now let's look at the two basic flavors they come in, calls and puts. These are really the two fundamental choices you can make.
And honestly, it's pretty straightforward. A call option gives you the right to buy. You'd use a call when you're feeling bullish, when you think the price is going to go up. A put option, on the other hand, gives you the right to sell, and you'd use a put when you're feeling bearish, when you expect the price to head down. Up or down, buy or sell, that's the basic split. And here's a really easy way to remember calls. Just think of it like this. You have the right to call the stock away from the seller. You're calling it over to you, into your account.
And for puts, you guessed it, it's the exact same idea in reverse. You have the right to put the stock onto somebody else. You're essentially forcing them to buy it from you. These little tricks can seriously help keep it all straight in your head.
All right, so we know what they are, and we know there are calls and puts. But why? Why do people actually trade them? What's the point of it all? Well, it turns out options are these super versatile tools that people use for a few very specific reasons. And when you look at it, it pretty much boils down to 3 main goals. You've got hedging, which is kind of like buying insurance for your portfolio. Then you have speculating, which is more like making a focused bet on where a stock is headed. And finally, generating income from stocks you already own. Let's just break those down real quick. Hedging, that's that insurance idea we kicked things off with. Like, let's say you own 100 shares of a stock, but you're worried it might drop. You could buy a put option to protect yourself. Speculating is all about leverage. Maybe you think a stock is going to shoot to the moon, but you don't want to shell out all the cash to buy the shares. Well, you could buy a call option to get in on that potential upside, but with way less money on the line. And then there's generating income. This is where you sell options contracts to other traders and collect a payment, kind of like a fee for taking on that risk.
Okay, for our last piece here, we've got to talk about maybe the most important concept in the entire options world, the dynamic between the person buying the contract and the person selling it.
And this is a huge distinction, so really listen up here. The buyer, we also call them the holder, pays a fee, called a premium, for that right we've been talking about. And the absolute most they can lose, it's just that fee they paid. That's it. Now the seller, or the writer, is on the other side. They're the ones who collect that fee. But in exchange, they take on an obligation. They have to make good on the contract if the buyer decides to use their right. And this means their potential risk can be way, way higher. In some cases, it can even be unlimited. So look, if there is one thing you take away from all of this today, please let it be this. Buyers have the choice. Sellers have the obligation. The entire options market, the whole shebang, is built on that one fundamental difference.
And there you have it, from being a form of insurance to a way to speculate, options give you some incredible power and a ton of flexibility. But, and this is a big but, that power comes with very real risk, especially if you're the one selling the option. We've just scratched the surface and covered the fundamentals, but the real question for you to think about is, how could a tool like this, with all its pros and cons, possibly fit into your own financial picture?